A 95-year-old man doesn't need to win the market anymore. He doesn't need bragging rights. He doesn't need another headline. When someone that old makes the biggest financial decision of his life, it's almost never about maximizing upside. It's about eliminating the one outcome that can't be repaired, catastrophic loss. That's why what's happening at Berkshire Hathaway deserves your attention, whether you own Berkshire or not. Because this isn't really a Berkshire story. It's a how safe is your plan story. In the most recent stretch of filings, Berkshire has been doing something the crowd hates, selling more stocks than it buys, quarter after quarter, and stacking cash and short-term treasuries to a level that's hard to even visualize, roughly in the high 300 billions range. While headlines scream about artificial intelligence, record indexes, and the next decade of innovation, Buffett's company has been quietly building a financial bunker. Not a dramatic press conference, not a doom and gloom prediction, just a steady, disciplined refusal to overpay. And here's the part that should make you think Berkshire is not a struggling business hiding in cash because it's scared. Berkshire is a cash-producing machine, insurance, railroads, energy manufacturing, real businesses that throw off real earnings in good times and bad. That means the cash pile isn't dead money by accident. It's there by choice. People hear Buffett is holding cash, and they jump straight to one conclusion. He thinks a crash is coming, but that's not how Buffett operates. He's not a headline forecaster. He's a risk manager. He's an opportunist. He positions himself so that if the world stays calm, he survives just fine, and if the world breaks, he becomes the buyer when nobody else can. If you have retirement savings, if you're counting on markets functioning normally, if your plan assumes you'll get average returns without living through an average drawdown, then you need to understand what Buffett is really doing. Because when the most patient investor in modern history stops swinging and starts hoarding dry powder, the message is simple: the price of normal has gotten dangerously expensive. To understand the message, you have to understand the playbook. Buffett's edge has never been predicting the exact moment a market falls. His edge is that he refuses to be forced into bad decisions. He designs Berkshire so it can wait. And waiting, when everyone else is fully committed, is a superpower. Go back to bubbles and panics most investors only know from charts. During the late 1990s tech frenzy, Buffett looked outdated, old economy, no internet winners. People mocked him. Then the dot-com bubble deflated, and suddenly boring looked brilliant. Before the 2008 crisis, the environment felt unstoppable. Easy credit, financial engineering, housing can't fall nationally. And Berkshire, it was cautious. It carried flexibility. It wasn't built on fragile funding. So when the system seized up and great companies needed capital fast, Buffett could demand terms nobody else could. Preferred shares, warrants, high coupons, deals structured so that even if things stayed ugly, Berkshire got paid. That's the point most people miss. Buffett doesn't get rich from crashes. He gets rich from being liquid when other people are illiquid. He gets rich from having certainty when everyone else is desperate. Then look at 2020. When markets dropped fast, Berkshire didn't pretend to be a hero calling the bottom. It waited, watched, and moved selectively. Buffett doesn't buy because prices fell. He buys when the price is low relative to the business, and when the future doesn't require perfect conditions to work. This is why cash matters to him in a way it doesn't matter to most investors. For the average person, cash feels like missing out. For Buffett, cash is optionality. It's the ability to act when the world offers bargains. And those bargains almost never show up during calm, euphoric markets. They show up when confidence breaks. So when you see Berkshire accumulating an unusually massive reserve, don't interpret it as fear. Interpret it as a signal that Buffett believes the market is pricing risk like risk doesn't exist. And that is always when risk is most dangerous. Let's talk about why this moment feels different. Not because this time is special, but because the math is different. For much of the 2010s and into the early 2020s, markets lived in a world of near zero rates. When safe yields are close to nothing, investors get pushed out the risk curve. They pay higher and higher prices for future earnings because there's no attractive alternative. But when cash and treasuries pay real yields again, the entire logic of valuation changes. If you can earn roughly 4 or 5% on short-term government paper, you need a stronger reason to take equity risk at stretched prices. Stocks have to offer a meaningful premium over the risk-free rate. When valuations are high, that premium shrinks. And when the premium shrinks, the market becomes sensitive, hypersensitive to disappointments. Now add the second ingredient, profit margins. Corporate margins have been unusually strong relative to history. That can persist for a while, but it's not guaranteed forever. If wages rise, if financing costs stay high, if competition tightens, margins can compress. And when margins compress in a market priced for perfection, the repricing can be brutal. Third ingredient, narratives that justify any price. Today, it's AI. In other eras, it was telecom, dot-coms, housing, crypto, different costumes, same human behavior. Innovation is real. Productivity gains are real. But real doesn't mean any price is fair. When valuation metrics like the CAPE ratio get into rare territory, levels historically associated with low forward returns, what Buffett hears is not crash tomorrow. What he hears is The next decade might pay you less than you expect, and the drawdowns on the way there may be larger than you can emotionally tolerate. That's the quiet danger for retirement investors, not the dramatic one-day collapse. The danger is a 30-40% decline early in retirement that changes the entire sequence of returns. The danger is needing withdrawals when the market is down and turning a temporary drawdown into permanent damage. So if Buffett is looking at today's mix, high valuations, real interest rates, fragile confidence, heavy concentration in a few mega-cap winners, and choosing liquidity, he's not making a cinematic prediction. He's making a decision based on expected return versus risk. And right now, that equation is not as friendly as it looks from a chart making new highs. Now let's decode the actions, because actions are cleaner than interviews. Berkshire has been a net seller for an extended stretch. Not because Buffett suddenly hates stocks. Not because he's anti-America. It's because he can't find enough opportunities that meet his standards at today's prices. 2. The selling has included names Berkshire has historically loved. When a long-term holder trims a crown jewel position, it doesn't automatically mean the business is bad. Often it means the business is wonderful, but the price is no longer wonderful. And price is what determines future returns. 3 buybacks have slowed dramatically at times, even when Berkshire shares pull back. That matters because Buffett has been very clear for years he'll repurchase Berkshire stock when it's meaningfully below intrinsic value, and when doing so is the best use of capital. If buybacks pause, it suggests a simple conclusion: either the stock is not cheap enough or the opportunity cost of keeping cash is high because he expects better pitches later. 4. What is the cash actually doing? It's not sitting in a vault. It's often parked in short-term treasuries, liquid, safe, yielding. That means Berkshire is getting paid to wait, and that is a huge change from the zero-rate era when waiting cost you a lot. 5. When Berkshire does buy, the purchases tend to look like quality at a reasonable price, not story at any price. Strong cash flows, durable moats, businesses that don't need perfect macro conditions to survive. So what is the message? It's not sell everything. It's not the end is near. The message is the opportunity set is thin, the market is priced optimistically, and liquidity has become valuable again. The crowd hears cash and thinks timing. Buffett hears cash and thinks control. Control over when and how you deploy capital. Control over your ability to survive ugly markets without being forced to sell. Most investors don't lose money because they were wrong about a company. They lose money because they were forced into the wrong decision at the worst time. Berkshire is designed to never be forced. So what exactly could Buffett be preparing for? Not one specific event. A range of stress scenarios. Scenario A, credit stress. When rates stay high, refinancing becomes painful. Companies that looked fine at 3% debt don't look so fine at 7%. If defaults rise, spreads widen, and suddenly the cost of capital hits everything: stocks, real estate, private equity, venture, leverage buyouts. Liquidity disappears fast when credit tightens. Scenario B, and earnings reset. Markets can levitate for a while even when fundamentals slow, until they can't. If earnings growth disappoints while valuations are high, the adjustment doesn't need a recession to hurt. It just needs less good than expected. Scenario C, concentration unwinds. When a handful of giant stocks drive index performance, the market feels safer than it is. If leadership cracks, passive flows can amplify declines because indexes become crowded trades in disguise. Scenario D, geopolitical or commodity shocks. Energy spikes. Supply chain disruptions. Insurance losses. You don't need to know which shock or when. You just need to know that shocks happen, and markets don't price them when confidence is high. And here's the key: in every one of those scenarios, cash is not just protection, it's bargaining power. In a stress event, great assets go on sale not because the assets are broken, but because someone needs liquidity now. That's when Berkshire can do what it has always done: offer capital quickly, with terms that are favorable, when others are paralyzed by committees, margin calls, or redemptions. It's also why a CEO transition, whenever it formally happens, matters less than people think. Berkshire isn't built around one quarter's performance. It's built around a culture: don't overpay, don't depend on fragile funding, and always keep enough liquidity to play offense when the world plays defense. So if Buffett has engineered Berkshire to hold an extraordinary cash buffer, the simplest explanation is the best one. He believes the odds of attractive opportunities in the next few years are higher than the odds that buying aggressively today will be rewarded. That's not fear. That's patience with a plan. Now let's make this practical, because you're not running Berkshire, and you don't need to. The goal isn't to copy Buffett's portfolio. The goal is to copy Buffett's thinking. Protect yourself from outcomes that permanently damage your financial life. First, know your timeline. If you're within 5 to 7 years of retirement, your biggest enemy isn't missing out. It's sequence of returns risk. A major drawdown early in retirement can reduce withdrawals, force lifestyle changes, and delay retirement even if markets recover later. A simple approach: many retirees use a cash or short-term bond spending bucket that covers 1 to 3 years of expenses, so you're not forced to sell stocks in a downturn. Second, stress test your assumptions. Ask yourself, if my portfolio drops 30%, what do I do? If the honest answer is panic, you're overexposed. The best portfolio isn't the one with the highest back-tested return. It's the one you can actually hold through a bad year. Third, respect valuations without worshiping them. You don't need to predict a top, but you should recognize when forward returns are likely lower and volatility likely higher. That may mean rebalancing, trimming concentration, adding quality bonds, or simply stopping yourself from chasing the hottest theme at the worst price. Fourth, keep some dry powder. Not because you know a crash is coming, because having liquidity turns volatility into opportunity. Even a modest allocation, an opportunity fund you can deploy during major drawdowns, can change your long-term results. Fifth, write them down now while things are calm. If the market drops 20%, I rebalance, not panic. If my favorite stock doubles fast, I review position size. I don't use leverage in my retirement accounts. Rules beat emotions when headlines get loud. None of this is financial advice. It's risk hygiene, what disciplined investors practice when markets feel invincible. Here's the real takeaway: Buffett's Cash Mountain isn't a prophecy, it's a mirror. It reflects a market where people have confused rising prices with falling risk, where innovation has become a reason to suspend valuation discipline, where the crowd believes liquidity will always be there, until the day it isn't. Buffett's genius has never been flashy. It's been consistent. He avoids the one mistake that ruins investors: overextending at the peak of optimism. So when Berkshire builds one of the largest cash positions in corporate history, you don't have to assume a crash is imminent to learn the lesson. You just have to accept a simpler truth: when prices are high, future returns tend to be lower. When confidence is extreme, surprises hurt more. When liquidity is plentiful, people forget it can vanish. Buffett is choosing to be paid to wait. He's choosing flexibility over bragging rights. He's choosing survival and optionality over chasing the final stretch of a crowded trade. And that's the question this entire moment asks you. Are you positioned for a world where markets don't behave perfectly? Because if your plan requires everything to go right, rates to fall, earnings to surge, AI to monetize flawlessly, margins to stay elevated, volatility to stay quiet, then you don't have a plan, you have a hope. Buffett is not hoping, he's positioning. You don't need 300 billion to copy that. You just need the mindset: protect your downside, keep your options open, and don't let a roaring market trick you into believing risk has disappeared. In the next chapter, whenever volatility returns, whenever prices finally offer real value again, cash won't feel boring. It will feel like power. And the people who built that power before the panic will be the ones buying when everyone else is coping.